Hey, good morning, everyone. It's Monday, April 7th. It is time for your weekly market update with Mission Financial Planners. Let's just jump into it. Um, there's a lot going on right now, right? Let's talk a little bit about some of the uncertainty that came out of last week. Markets dropped, tariffs went up, jobs refused to flop, right? They did. We had great job reports last week. So welcome to the first week of April 2025. There's a lot of contradictions right now between a strong labor data, maybe indicating the economy's in pretty good shape, but also policy-driven market volatility. So we're going to get into a little bit about what happened, what it means, and how smart money, like our partners at Kestra Investment Management, moved before the storm. Let's take a minute and talk about labor versus the tariff. So first of all, tariff shock. In case you haven't heard, there's a 10% baseline on nearly all imports. In other words, that gets announced and a sell-off immediately started in the market. However, there was a positive job surprise. There were 228,000 new payrolls versus 135,000 expected. So there's a little bit of a celebration there, right? But the challenger remains in layoffs and falling job openings, which is the other side of the labor story. In addition to that, some of the manufacturing indices showed some contraction signals last week. And then you've got some sector carnage going back to the tariffs. I mean, tech, as an example, year to date is down about 22.5%. And even defensive stocks and defensive sectors weren't spared last week either. So a lot of investors didn't rotate around or anything like that. They just got out, right? They just got out. And that's where the sell-off came from. Now, we know, or we're pretty confident, I should say, that the economy has strong bones, but maybe the rest is a little shaky right now. So the labor market is still resilient, but it's evolving. Immigration still remains key to a lot of sectors. There's also a shift. Value is now starting to become more in focus versus growth. Mid caps are holding stronger than small caps. When you think about rates and yields, the 10-year is now at 4%. The curve is no longer inverted. And by the way, an inverted yield curve is normally a signal for a recession. There is not an inverted yield curve at the moment, but we're still cautious about that, right? Some of the fixed income winners out there were short duration corporates and munis, all seeking inflows. Commodities, oil jumped up a little bit, gold went up a little bit. These are classic fear signals, especially gold. The dollar is strong. Hey, when the world freaks out, it still runs to the US. So while the macro headline is the macroeconomics side of this is saying we're okay, the market's acting like we're not. So what does it mean for your portfolio? Well, if you're with us, right, you know that one of our primary investment partners is Kestra Investment Management. And if you want to check out Kestra's preemptive playbook, just look at our post from Friday. That would have been April 4th. Check that out in terms of the details of what Kestra did. For a bullet point version, Kestra Investment Management saw the storm coming. They shifted away from growth into value and internationals. They reduced small cap, they upped their mid cap exposure, they reallocated fixed income to short duration and investment grade bonds. They are also using actively managed bond funds, which layers in a whole nother of flexibility to be able to move around within the actual holdings of the funds. There's also an increased fixed income across the risk profiles. This isn't hiding, this is just repositioning. But most